Hey guys, welcome back to the class 12. Now, once we have understood all the profile related matters of sales manager and credit managers, I am coming forward to teach you what is it to understand in the loan assessments part. What are the basics of loan assessment followed in today's modern banking world, right? So, I have made this video in two parts. This is class 12. This is basically the first part. Here we will discuss basics of loan assessment, how the loans are assessed from ground level by the banks, what are their core underwriting criteria. Listen to it carefully. So basics of loan assessment I have divided into three parts. One is the assessment of loan from the income side of the borrower. Second is the assessment of loan from the balance sheet angle of the borrower. Both are separate, right? Both are separately assessed. Different loan types are assessed from income side as well as balance sheet side. And then there is combination of both, where the banks use both income side and balance sheet approach to assess the loans. When we come to the income side, the banks basically follow the fundamental of the incomes or cash richness of the borrower. How much cash is generated by the borrower per month? Whether he is a salaried employee, how much net in hand salary is received by him? If he is a businessman, how much per month cash is generated, cash profit is generated out of his business? So banks want to see how much out of this generated cash, whether salaried employee, whether a businessman, we can use to repay the debt obligations of our or other banks or NBFCs. So bank play the game on the cash generations of the business only, right? So the businesses must be a good businesses who generate a very handsome amount of cash from their business, so that they are very much comfortable to repay the principal and interest obligations of the bank, right? So when we assess the incomes or cash richness of the borrower, then we use two ways basically. One is the financial way. Financial way is basically for the SCNP profiles, self-employed individuals who are doing business, entrepreneurs, right? So for calculating their cash richness, for calculating their cash generation monthly, we focus on the profit and loss statement of theirs. How we do that, we will learn in coming videos. So you need to understand, for calculating the cash richness, we take the profit and loss account. We calculate the monthly cash generation from the profit and loss account of the borrower, right? There is a different set of formula, different concept how we calculate it, that we will learn in coming days, right? That is the financial angle when we take the financials of the borrower to calculate. So then is the surrogate segment. Surrogate segment is basically when a self-employed individual comes to us for loans, but his financials, we think that his financials doesn't truly reflect the cash richness of his business. His financial don't really tell us how much cash is generated by him in a particular month or average per month, because his financials are basically managed as per the laws by the financial analysis. You know what I want to say here. So the banks or NBFCs use various surrogate products for that. So the most famous products used in it is the bank balances. If the client is having a very good cash balances, he is holding lakhs of rupees, 20 lakh, 30 lakh rupees, 1 crore rupees in his saving accounts, in the firm's current account, that means he is a very cash rich person. If he is holding that much cash, he is having that much cash with him, that means he must have been generating a very good amount of cash from his business, which may not be reflected in his financial statements accurately, right? So from the balances of his banks of various persons, like his account, his mother's accounts, his father's account, his wife's account, we combine the average balance of all the bank accounts and calculate how much average per month balance is maintained by him. Say for example, average balance per month in his all accounts are 10 lakh rupees in last 12 months. In last 12 months, he has maintained 10 lakh rupees average balance in his bank account. So we are giving loan, or the already some banks and NBFCs have given loan. So the total obligations of the borrower of my loan and the other banks or NBFCs loan comes out to be 2 lakh rupees per month. If someone is maintaining 10 lakh rupees balance in his account every month on an average in last 12 months, then it will not be difficult for him or her to pay the 2 lakh rupees EMI from that account. So that just says how much cash rich that person is. How do we calculate that average banking balances? That we will come across in the coming months, right? So that is called the banking product. What we call it? We call it banking product, right? Then there is another surrogate program that is called the track based surrogate program. See, if the borrower is not reflecting actual picture of his business in his profit and loss statement, his bank balances are not good enough to show healthy amount of balances, then how do we judge that borrower is generating cash from his business? How do we get that? So suppose to a borrower, you have given, not other banks. This product is applicable for existing loans only that you have given, not other banks, right? So you have given a loan of 1 crore rupees to the client earlier, 3 years back, 4 years back, and that EMI works out to be 5 lakh rupees per month. Suppose EMI is 5 lakh rupees per month, and in last 3 months there is not even a single bounce in the EMI, not even a single bounce in the EMI. So that means that person is paying 60 lakh rupees per month comfortably to us, and he is also running the business very satisfactorily. He is paying 60 lakh rupees EMI per year to us very comfortably. Just an example. You don't get into the figures of don't get into the accuracy level. Just to focus on 60 lakh rupees annual repayment. That means you somehow know that borrower is somehow generating cash that you have no documentary way to prove, right? But repayment, clean repayment of your loan track is a way to judge that he is generating something that you don't know about. So the banks use this track to fund the borrower. They take the latest outstanding, like for example in this loan the latest principal outstanding of the loan is say 25 lakh rupees. They apply some multiplier like 1.5 times, 1.7 times of that, and they give that amount as a loan to the borrower. Suppose 1.5 times of that comes to 37.5 lakh rupees. So 25 lakh rupees is already outstanding. So net 12.5 lakh rupees is additionally given to the borrower as a top-up loan. That is a track-based assessment. Here the bank doesn't do check any financials or doesn't believe in banking. They believe only on the running tracks of the borrower. So this product is applicable generally for our loans which we have already given to the borrower, and in some banks there is another product related to this which is called the BT product, balance transfer product, in which if the client is having any LAP or any loan from existing other banker and you are taking over that loan in your organization, then you can sanction the loan basis the satisfactory track of this loan, like by applying this multiplier only, right? So that product is called BT product generally. That product is also in existence in many banks or NBFCs. Then the third type of product is basically the discounting of rental income that we call LRD product, lease rental discounting product. So in the lease rental discounting product, when the borrower is receiving good amount of rentals from concrete sources, from very good corporates with a very good external ratings from CRISIL, CARE, ICRA, very good external rating. He is receiving very good rentals like from Reliance, from any banks, NBFCs. He has a property and he has given them on rent. He is receiving a rental income from them. He has signed the agreement for say 10 years with them, and he wants to avail loan from us, right? He is not having any other income. Then what we will do? We will take those monthly rental, like suppose he is receiving 70,000 net rentals after paying all the taxes or maintenance cost, 70,000 rentals per month in his account. then what we will do, we will ask him to open a escrow account with us. Then we will, when the rent is paid by that corporate, we will mark lien on that rent, in our escrow account. And from that 70,000 receipt, we will first recover our EMI. Say our EMI is 40,000 rupees. We will first recover our EMI, and the balance 30,000 left shall be released to the borrower for his personal use. So that is a very safe product, right? So this is called the lease rental discounting product, right? Then there is another product which is used by some of the organization that is linked to the sales level of the borrower, that is we call the GST product. Here what the organization do, they define a percentage profit with each industry type. For manufacturing segment, a separate profit margin; with the services segment, a separate margin; trading segment, a separate margin. They define a separate percentage margins for their employees. For example, they say for a manufacturing segment, you can take 4% as profit margin. So by 4%, these organizations means that the manufacturing segment that your borrower is working in, he is generating 4%. He is generating 4% cash profit. They assume that he is generating cash profit of 4% from his business. They ask you to not to apply any science, not to assess any document, and just follow this fundamental policy, which is designed by their very knowledgeable or analytic team in central level. So they designed a average margin level of 4%, and you just need to take the sales of last 12 months from his GST returns. You need not to take any financials. Last 12 months sales, you apply the 4% margin on that sales, then you will come across with the total cash generation of his business that you assume as per your bank that he is generating from his business. Although you can already see that this method is very assumption based and very risky in itself. So, but organizations are following it. We cannot say anything about it. So this product is also in practice, that is called a GST product in practice, right? So all these products that we have discussed, that is the financial based, that are the surrogate products. Financial based are more kind of secure, since you are taking all the documents here, financials, banking, GST, you have the complete 360-degree picture of the borrower. So they are more safer than these surrogate products. In surrogate products, you are not having 360-degree view of your borrower, since you are taking only a very limited docs with yourself, right? So all these assessments of these loans are done basis the FOIR, fixed obligation to income ratio. We will know about it in coming videos. You calculate the FOIR and do the assessment. In all of these loans, you take a very good collateral. You are fundamentally believing on the cash generation of the business. You are funding the client for long term, like 10 years, 15 years, 20 years, and you are believing that the client will keep on generating that cash for coming 10 years, 15 years, 20 years, right? So you are taking call for a very long time. You are assuming for a very long time. So you need to secure yourself more. So you take a very good collateral coverage in these type of segments. Say if you are taking a property of 100 rupees market value, then you give only 60 rupees of loan, 50 rupees worth of loan on this property, and you keep a healthy margin for yourself for your security in such type of loans. Obviously, since financial based are more secure than surrogate products, you will want to be more secure in surrogate products. Hence, you will be keeping more margin percentage in surrogate products, and you will want more good quality collaterals in surrogate products than the financial ones, right? That is very well understood. These loans are for very longer tenure. For BLPL, they may be of 2 years, 3 years, but rest of the loans can be for longer period of time. So LAP, loan against property, housing loan, business loan, personal loans, auto loan, commercial vehicle loans, drop line overdrafts, all these type of facilities are given under this approach by the banks. So these loans are given to individuals in their individual name. Like I am Ankush Jain, I can take the loan in my individual name as well, or I can take this loan on my business as well. by making the business as borrower if I am self-employed like this, right? So these loans are not focused on balance sheet part, less focused on balance sheet part. They study the balance sheet. If this is a financial based profile, they study the balance sheet, but they don't give too much, value to it. They focus more on the cash generation part only, right? So this is the first way to assess the loans, which is becoming more and more famous in today's market in India. And RBI is also, our Reserve Bank is also promoting this way of assessment of borrowers, since in the MSME segments, the financials can be window dressed and may not reflect the true picture of actual cash generation of the business, right? Then we come to the second approach, which is the balance sheet view. Here, the focus is more on the worth of the business, more on the liabilities, more on the asset side of the business, less on the profit and loss account. In this segment, these are mandatorily the SENP profile, self-employed segment, and all the products here are mandatorily financial based product. Financials are taken in this segment. So you focus more on balance sheet and less on the cash generation or profit and loss account, right? These types of loans are done by the business banking departments, that are the working capital departments of the bank. They are for the shorter tenure, for like CCOD limits you do for 12 months period, machinery term loan you do for 5 years period. These are for shorter tenure, and good call on collateral is taken. Since you are doing too much financial analysis, you are focusing too much on borrowers market reputation, market net worth, and so many things that we will learn in coming videos. You take good call on the collateral. So collateral discounting is way much better in this segment. Like for 100 rupees of property, you can give 100 rupees of loan. For 100 rupees of property, some banks are even doing 200 rupees of loan. So good amount of value, good amount of call is taken on the collateral in this segment. And in this segment, there is a separate concept of primary security. The asset that is created from your loan is also taken as primary security, and collateral security is taken separately in these types of loans. And we will discuss these concepts in later part of our series, right? Now we coming to the third part, that is combination of both income side and the balance sheet side. That is also a modern day phenomena that more and more banks are using nowadays. So this is a modern day plan. So banks are using a bit of this, a bit of this. By that I mean they are focusing on income cash generation, but at a decent level, and they are also focusing on balance sheet, but not they are not becoming too much rigid on the balance sheet like they are in this segment. They are not too much rigid. They are also not too much rigid on the income side like we have studied in these segments. So they are using basically average of both to decide the fundability, to decide the loan amount of the borrower. So they focus on the balance sheets. If cash flows are good, then they can take call on some of the issues in the balance sheet, right? So they use combo of both products, like for working capital, for term loans if they want to offer. So they use both these approaches to combine them and give a joint product and joint offering to the customer. So this is a thing that I mostly value the most. I think this is the approach that we should follow in our coming future. Not becoming too much rigid, be flexible, be open to all kind of things, and do away with traditional practices of rigidity, right? And even if I say that in today's scenario, the business banking segment is also coming up with the surrogate variants, like we have studied here for banking products and GST products that we will discuss in our series. But they are also coming up with surrogate variants to fund their client to capture more market share. So this is also becoming a modern day phenomenon nowadays, right? So I hope you have understood all the concepts of class 12. Next video, class 13, we will discuss the second part of our basics of loan assessment. I hope you have liked the video. Thank you very much.